the jobs report and employment numbers, this has been, I mean, it's all about revisions this year, right? Or the last 2 years, but really over the last year, the
Mhm.
revisions to the numbers that are coming out are bananas. They completely changed the stories that we're seeing. So let's just take a look at a couple of the headlines, if you don't mind. Stock market today: stocks slide after surprise August jobs report,
Mhm.
and the jobs report surprise adds to case for bigger Fed interest rate cuts. What's your
Yeah.
take on these things?
Yeah, I think the second one is really interesting because there's been this debate for a few weeks now as to whether or not the Fed is going to cut by 25 basis points or 50 basis points in the next upcoming FOMC meeting on the 18th of September. After this report, though, today, the futures market is really printing a much higher probability of just a 25 basis point cut, and largely because the concern around how much of an impact the interest rates have had on the economy aren't as big as we once thought. Unemployment rate actually came down by 10 basis points, which was forecasted. Non-farm payrolls are a little weak, but really not too far off from a forecast of 160,000. They came in at 142,000. And so it looks like the futures market is saying, great, we don't need to cut aggressively. We think there's a 71% chance that we cut by 25 basis points in a couple weeks from now. So I think that's sort of good news, but it seems like the markets have reacted pretty negatively to the report, and we saw a pretty strong pullback today. Almost 3% on the NASDAQ, about a 1.5 on the ES. And obviously, crypto has followed suit from a correlation perspective and started to pull back as well. Very interesting day in crypto. My take on this, though, is the revisions are an interesting one. It feels like the demand on the labor departments to print accurate data quicker is higher than ever because we've just never really paid this close attention to these types of economic indicators. And I guess there's some speculation out there that the data might be manipulated, stuff like that. But I'm not so convinced of that. You know, there's a lot of companies that are polled for this data, and it's a sampling process. You know, the revisions largely come from a data collection process that is comprehensive and layered, and is shared between multiple agencies. So I feel for the data collection agents, or I'm not sure what their exact title is, but for the people involved in actually collecting and analyzing this data, man, their role almost seems as important as the things the Fed chairman says in the FOMC meetings, right? Like the pressure is on to print accurate data, and when revisions come in, people are pretty upset about it. So that said, I think the news here might be a little overreactive. The economic indicators that we're reading here are pretty positive. You know, the recession fears I don't think are as big as they once were. We might actually still be heading towards the possibility of a soft landing. I'm thinking back to like June of 2022 when we printed 2 negative quarters in a row, and the news was all hyped about the possibility of a recession. Fast forward a year, that never happened. That never came. In fact, the economy seemed to bounce back even further, printing quarter over quarter GDP growth up until this last quarter, showing a 3% increase. So it just seems like we're not getting the economic indicators that are telling us a recession is impending or on the horizon, other than sort of our sensitivity to variances in these types of jobs reports. And that's where I'm wondering if we're reacting a little too heavily to these things.
Well, I find it fascinating, one, that you would say that you don't think that the data is being manipulated.
Okay.
I mean, not that we would know for sure or not, but um, the I'm not going to put it past any U.S. government looking at it from the outside to manipulate the data to be able to gain in the short term. Like there's always been revisions to these numbers
Mhm.
uh, constantly, but not to this degree. The swings are so large that sometimes it'll go from net positive to net negative, and the revisions are almost always like 95% of the time in one direction. It's never like the other way. And you're like, okay, well, why haven't you fixed this? Your way of calculating this. It's been a year and a half. This has been going on,
Hmm.
and they just so happen to always favor the current administration, so that they could hang their hat on something. Oh, we have new jobs that are added. Oh, excuse me,
Interesting.
revised 3 months later, and now it's negative. And so you're seeing the when I see those changes, I always like to look at the betting markets, and because I want to see, are the charts sort of reflected in the same way on Polymarket, on Predicted, and all that sort of thing to see for the presidential election. And the worse the news is for the administration, it seems like the more the revisions or the numbers that come up are made to seem better than they are, but we don't know for sure. What we do know though is that we've had more leaks of this information of the reports. Have you seen people talking about this?
Not the
Where
leaks, no.
yeah, where the reports are being leaked out like an hour or so beforehand to certain players within the markets, and then the markets move an hour before or up to an hour before the numbers come out, and then there's a big sell the news sort of event. So like I think even today crypto shot up, shot up in the context of intraday, and then came back down the other end. But this is happening more and more before the numbers actually come out, and so there's this sort of like conspiracy underneath. It's like, hey, are they leaking the numbers? Is there a leak within within these bureaus that are allowing larger players to be able to position against retail investors? That to be is pretty interesting. But who knows? One thing's for sure: whatever number we get for the reports, don't pay attention to it until 3 months from now.
That's
Wait
right.
for the revised number.
Yeah, I think if I could share just a research paper from the St. Louis Fed, and I think that this is really what informs my opinion around the idea that we have to be a little careful as to how we respond to preliminary data. This is a research paper that really just kind of covers this idea of whether or not employment data is actually biased from the individual agencies. And I think it's important, especially around non-farm payroll data, to recognize how much of this data is preliminary and also start to measure the magnitude of the revisions over time. So like this chart right here actually starts to plot out how frequently we see magnitudinous changes in the employment data as we revise it. And I guess the point is like the median revision magnitude is one of those things that occurs frequently enough to where we should expect it. So I think our sensitivity occurred because for a period of time there, the revisions weren't as strong as they were recently. But I guess my question is, have they been this magnitudinous in the past? And can we observe that over time? And again, I think maybe a part of it is really understanding the collection of data and how that process works to make it more accurate over time, because it's all really kind of based on survey data that the BLS collects. And over time, as new data comes in, because we're waiting for responses, that data can change, right? Especially if your sample includes information that wasn't previously collected and now suddenly is, that it might change the data to a large degree. And that's simply a sampling bias problem, right? Where initially our sample didn't reflect some of the pockets of information that are crucial, and now suddenly they do. So I guess I'm taking this more from like a statistical standpoint and less of a concern about government manipulation, but happy to be wrong. Like I'm obviously the type of person that's not quick to jump into conspiracies, but how it would be manipulated and the motivations behind it is what I'm really curious about.
Right. Well, the thing that bothers me the most about it is and I think Daniel DiMartino Booth, a former Fed insider, author of the book Fed Up, has sort of been like suggesting this, implying this, is that the Federal Reserve, the central banks do use this information in order to help make their decisions about
Mm-hmm.
what to do with interest rates and liquidity and all that, and they're not mentioning these revisions as being problematic. Like, they're not saying anything about it, and it bothers me that they're saying, "Oh no, the markets are good, labor markets are good," and you go, but no one's. They're never saying, "But we know we have to wait 3 months in order to see if the revisions are fine," which
I think
means
that latter of what you just said there is the critical part. If they're already aware that revisions will come in and they're less sensitive to preliminary data, then they're driven by the more accurate revisional data rather than the early preliminary data, right?
Are they though? Because when Jerome Powell's having this conference, or when he's speaking at Jackson Hole or whatever, they're never mentioning that, hey, the data is like wildly off, and we know we can't. We know that you got this report last month, but we really got to wait. They're never saying that. They're saying the labor market's doing great, whereas all indications are showing that we're not in recessionary territory, but we are contracting.
Yeah.
I mean, that's essentially the definition of a recession, even if it's a shallow one or the beginnings of one.
Sure. Fair enough. Uh, Peter says the report is generated by ChatGPT. Here's the twist. Okay, that makes a ton of sense. It's a good question. I don't know if they truly are sensitive to preliminary data or not, or driven by that data. I think you make a fair point. That said, I know that the Fed chair governors are governors. I'm not sure I'm using the correct term there, but are not stupid people, and they certainly are aware of how these biases can exist within the data and how to respond appropriately. But I think the bigger question still is around how this data is managed and how bias is accounted for in the collection of that data, and how accuracy is monitored. So I think it's important we at least like try to observe what the collection process looks like, how they verify the data, how accurate it is, and how the revisions have changed over time. Is this kind of like a recency effect, right? Where we're observing this big magnitude of revisions of data and automatically assuming that something's wrong with the process without observing the whole history of how this works. Like, maybe that's my point.
Absolutely, and in fact, I mean, when it comes down to it, we want to make money in the markets,
Yeah. Yeah.
and it
Yes.
does not benefit me at all to think that they're stupid. If they are, I mean, we're in trouble. So I might as well think that they know what they're doing, and that if they're relying on data that they know is going to change later on, or it's inaccurate or whatever, I assume they're factoring that into their decision. But I also am assuming that they want us to believe that this data is accurate, like when it first comes out. The whole policy of of the Federal Reserve is an expectations policy. They need to manipulate people's behavior based on what they're saying, and they need us to behave in a certain way. And so I'm fine with that, because then they're like, okay, if the shepherd is trying to herd us in that direction, and that direction is chart up and to the right, well, I'm not going to start yelling against them. What am I, Peter Schiff? I don't want everything to collapse. I wanted to continue going up and to the right, so I'm not looking to rock the boat. Make the money and just be ready to pull back on the brakes when the inevitable revisions come. The last thing I wanted to say on this, though, and I'd love to get your quick take on it, even though you know, I'm just springing on this you right now, and that's the idea of the moves that we've seen recently in the markets, in the tech sector and in crypto, or especially in the tech sector, have been significant. When you're looking at how people are talking about online, we've had a decline, blah blah blah. It's not 50% down in the markets or anything like that, but it is noteworthy.
Mhm.
And I just wanted to point out something that we've been touching on previous after hours, which is this idea of gamma within the markets. So the options markets really are, I mean, not just my point of view, but for a number of economists, the options markets really are what drive a lot of the moves that we see in index names and mega cap stocks.
Mhm.
And so we have the situation where what might otherwise have been a small decline can then get exacerbated to the downside, because the dealers need to hedge their portfolios in order to account for the puts that are going into the money. So you get this gamma effect to the downside, where we're getting this big drop, and a lot of people are screaming and yelling, "Oh my God, this is a trend change. We're going bearish. There's going to be a recession. Markets are going to be down 30%." But it could be, once again, a buying opportunity, because if the drop in the markets are happening because of a structural change and not a liquidity change and not a change in valuation or anything like that, then it's a buy the dip and wait for it to go up and to the right. because the dealers are going to those options will get monetized. Volatility will then get supplied again, and there's no reason not to expect up and to the right. And so to me, when I see stuff like this in the markets, I feel like I like knowing, hey, these are the dynamics at play, and I don't have to worry that the sky is falling. I don't have to wake up and the S&P is down 50%.
There's nothing better than observing those types of patterns in the options market for a sense of where we think forward-looking price will go. So, do you feel like this is a stronger indicator than relying on even just implied volatility relative to historical volatility? This gamma observation or gamma squeeze, is that sort of the leading indicator from your perspective?
Yeah, because the implied volatility versus a historical one gives us our premium and discount, like what the options are priced at, but it doesn't let us know what the weakness is within the market. But if the gamma is large enough, then we know that the ground is the environment is set up that if a catalyst did occur, well, then we can have the negative effect, or the opposite. If some good thing happened, we can get the upside. And I like knowing when those periods, when the ground is set for that. And if it's not set for that, well, then I don't worry about it. I don't really care unless something structurally changed with, Nvidia. Like if AI all of a sudden doesn't work anymore and whatever it is, or Elon Musk suddenly died, okay, fine, then maybe I'll short Tesla. But until those things happen, if there's no negative gamma that I have to worry about, then I'm not expecting a big decline. And if a big decline does happen because of those negative gamma, those are buying opportunities.
Understood. I love it.